And thanks to everyone here today who's joined us to hear the Regions story. It's something we're proud of and excited to present to you. Before I get going on my prepared remarks about the consumer bank, we'll see just a brief video to share a little bit with you Regions' brand of banking. This video gives you just a brief taste of how we're combining technology and proactive guidance to deliver better outcomes for our customers. It's allowing us to drive more value for them, grow our bank, while at the same time become more efficient every day. During my prepared comments today, you'll see a few themes emerge. One is how we're going to lean into our superior customer service advantage and the primacy and loyalty of our customer base. Secondly, how we're going to continue to invest in an omnichannel experience that delivers more value for our customers while at the same time allowing us to become more efficient all the time. Third, we use strong data and analytics in everything that we do to target our customers appropriately, to deliver them the right solutions, as well as to prioritize our resources effectively. And fourth, we're going to lean into a strong operating advantage we have in the mortgage business to grow our share in that business for the long term. Let's jump right in. Regions Consumer Bank drives roughly 58% of the revenue of Regions and about 53% of the pre-provision income. It's split between three businesses. Last year, the retail business delivered 86% of the pre-tax income of the consumer bank, mortgage 12%, and our indirect business 2%. We operate across 15 states, as was mentioned earlier, with roughly 1,450 branch sites. And we serve over 4.3 million consumer households and 370,000 small businesses. Let's take a quick look at the balance sheet. The consumer banking group has roughly 61% of the deposits of the company. It's a deep and granular deposit base, as has been mentioned already today. About a third of that is in non-interest-bearing accounts, and about half of it is in checking accounts. If we look at the other side of the balance sheet, we have $32 billion of loans, which is just a little shy of 40% of the loans of Regions. 44% of those are first mortgages, and 70% are secured by real estate. 16% of our loans are in the indirect business, of which about 60% of those are secured by automobiles. The remainder is split between credit cards, direct loans to our consumers in our retail branches, as well as small business loans in our retail branches. All of our product and business strategies are looked at through a lens of risk-adjusted returns and relationship opportunity, and we constantly look at the balance of our business and manage our concentrations. Some examples of that have been how we've treated our indirect auto business. A few years ago, we exited a flow arrangement we had in indirect auto because the risk-adjusted returns were challenged, and we put it into a runoff portfolio. And as John mentioned earlier today, the risk-adjusted returns on indirect auto business have been very challenged and are really suboptimal for us. So we are exiting that business with our last fundings occurring right around the end of the first quarter. Additionally, if you look at our mortgage business, we focus on direct origination, not correspondent lending. Direct originated mortgages drive roughly twice the risk-adjusted returns of correspondent loans. If you look at our credit card portfolio, our relationship approach on credit card portfolio has allowed us to have 80% of our credit card holders actually have a deposit account with Regions as well. Once again, driving stronger risk-adjusted returns and better performance through various credit cycles. Last but not least, we focus on balanced business and managing our concentration limits. We've grown third-party unsecured loans pretty strongly the last couple of years. You will see that level out this year as we start to approach our concentration limits and keep our disciplines around that. Everything we do goes through a filter of risk-adjusted returns. It's so important that we get paid for the risk that we take. Let's talk a little bit about our consumer bank strengths. We've talked a lot about our markets today. It's a nice combination. We have strong, dependable, and stable markets which give us great sources of income, but we also operate in some of the fastest growing metros in the United States. As I mentioned earlier, we operate in 15 states. They hold about 1/3 of the United States population. Our core markets reside in the states that you see on this slide in blue. And in those markets, we have some common characteristics across them. Strong share, low-cost deposits, high primacy, and very granular, loyal relationships. These markets represent between 85% and 87% of our loans, deposits, and revenues in our retail bank. They're not only dependable, they're actually growing in a dependable fashion. Over the last 3 years, these markets have grown at a 3.5% compound annual growth rate in revenues, and we can continue to see that happen as we go forward. Add to that the fact that we operate in 24 of the top 50 fastest growing metros in the United States. These metros lie both within our core markets as well as in other markets that we operate in. You see some of the markets here where we're making investments, and as mentioned earlier, in 3 of those, Atlanta, Houston, and Orlando, we'll be making investments across our lines of business with not only retail distribution investments and consumer investments, but investments in our resources in the wealth management area and in the corporate banking area. Additionally, we operate in other fast-growing metros where we're having nice growth rates, and we have future opportunities to make investments to accelerate those growth rates as well. Regions 360 is our team-based, needs-based approach to bringing all of Regions to our customers every day. It's critically important that the consumer bank is especially good at this. We are the storefront for Regions. We really focus on it in 2 different ways. One of those is through proactive guidance with our certified bankers, which helps fill out all the core needs of our customers. That's really a penetration play that we can execute within our retail branches. But very importantly, when having the right needs-based discussions with skilled bankers, we uncover more complex needs, opportunities to introduce our partners in the wealth management area and in the corporate banking area to solve those complex needs for our customers. We've had strong results across both of these efforts. First of all, from a penetration perspective, we've increased Regions 360 relationships in the consumer bank by 3.5% last year. And a Regions 360 relationship is very simply a fully valued, fully sold relationship which drives 140% more revenue than your average consumer banking relationship. Great progress on penetration. Additionally, though, we've done a really terrific job of introducing our experts in wealth and corporate to our customers to solve their more complex needs. During 2018, we drove over $170 million of incremental revenue from referrals. Additionally, 30% of all of the mortgages that we originated last year were referred from our retail branches, and we introduced over 70,000 clients to our experts in the wealth management area for investment advice and investment products. The hallmark of Regions is our relentless customer focus, and we're rewarded with top decile customer loyalty and very high brand favorability. 75% of our customers indicate that they'd be willing to refer friends and family. And in fact, in 2018, we opened up over 50,000 core checking relationships from referrals from our loyal customers. As John mentioned earlier, 60% of our deposits are held by customers who've been with our bank for over 10 years. And not only do we have loyal customers, we continue to grow. We've consolidated over the last 5 years 284 branches. In spite of that, we've grown consistently for 6 years straight and continue to have growth rates that, per third-party conversations and relationships, appear to be at the top of the industry. And it's not just working with core loyal customers, it's attracting the next generation of banking customers. 50% of our new checking account openings today are with customers under the age of 30. And you see a depiction on this slide of some of the card relationships we have through our Southeastern Conference affiliation, being the Bank of the Southeastern Conference. And we're fortunate to operate in all these market areas, attracting the next generation of banking customers. It's clearly a strength of ours, and we get recognized by numerous third parties. Here's just a few on this slide. But during 2018, no less than 12 third parties recognized Regions as the #1 or #2 financial institution in customer experience, customer satisfaction, and customer loyalty. This is clearly a competitive advantage for our bank. And what does it do for us? It drives industry-leading primacy with our customers. Over 90% of our checking accounts are the primary checking account of our customers. Why is that important? It provides us stable, low-cost deposits. 92% of all the consumer deposits are held by customers who have their primary checking account with Regions. We've had great performance across that base, and these primary accounts also have high activity levels with us, which drives non-interest revenues and makes us the first choice for their future financial needs. Our low-cost deposit base is probably the greatest financial contributor to Regions' overall financial results coming out of the consumer bank. As mentioned earlier, it's roughly 61% of our deposits. It's a very favorable mix with a lot of non-interest-bearing accounts, about roughly 33%. And we consistently have deposit costs at half our peer averages. And through the rising interest rate cycles, we've had one of the most, if not the best, low deposit beta as we've navigated through those interest rate increases. We have a strong relationship-focused card and payment offering. It's driven high activity and high growth levels. Our debit card portfolio has had the #1 Visa Power Score for 17 straight quarters. The Visa Power Score takes penetration, activation, and utilization to signify the highest performing debit card portfolio in the industry, and I'd suggest the most profitable one. On the credit card side, we have outpaced industry growth in both spend and balances over the last 3 years, with a compound annual growth rate of spend of 12% over that period and 9% on balances. We've also been an early adopter of payment innovations, wallets as well as real-time payments. And we've introduced proprietary products for our customers, like our Regions Lock-It card controls, which allow our customers to lock and unlock their card transactions in real time from their mobile device. Additionally, we recently rolled out a great rewards program for our credit card reward customers. Our rewards multiplier gives benefit for relationships and has our customers earning additional rewards and multiplying their rewards based on their deposit relationships with the bank. Clearly a great relationship product for us to continue to grow. Now let's talk about how some of these strengths are going to play going forward as we continue to grow the consumer bank. First of all, we leverage data and analytics in all that we do. It's absolutely essential for us to understand our customers, understand their behaviors and their desires. This helps us drive our omnichannel approach, meeting our customers where they want to be met. Omnichannel allows us not only to add more value for our customers, but to do so more efficiently every day. We're utilizing geospatial analytics to drive our market strategies and our thin network strategy that allows us to consolidate effectively and grow efficiently in the growth markets that I mentioned earlier. And data and analytics are at the core of our proactive guidance, meeting our customers at every touch point with things like Rosie that John mentioned earlier. We also are using advanced analytics to not only improve our credit experience, but also improve our credit decisioning and our credit outcomes, as well as our ongoing credit monitoring to manage our risks. Our customers expect us to be excellent across all of our channels. We've successfully rolled out digital capabilities and automation that allows our customers to bank when and where they want. We've messaged our customers and educated them on the convenience of 24/7 banking, especially for their simple transactions. We've seen extremely strong adoption. This is creating efficiencies for us. It's also allowing us to focus our bankers and our certified bankers on providing more proactive guidance and messaging to our customers, driving more value for them. 90% of all of our customer interactions today are automated or in the digital environment, but 60% of our customers still see value in visiting a branch and spending time getting guidance from our certified bankers. As mentioned earlier, 80% of our sales are generated from our branches and our certified bankers, even as we continue to grow our digital account openings at an aggressive rate. We're taking advantage of all the opportunities across this omni-channel experience. It's driving more customer value, driving more revenues, and it's doing so at lower costs. John mentioned Rosie earlier. We've operationalized a state-of-the-art system and platform to drive smart guidance to every touch point that we have with our customers. It's core to our strategy. Rosie updates 350 different characteristics of customers and known prospects every single day. It then drives a next best action to improve the financial life of our customers to all of our touch points, where we can meet the customer as they come into us in a reactive nature with some good sound advice, or we can reach out to them proactively to deliver that advice. Rosie also benefits from machine learning. It's constantly interrogating the results of these efforts and optimizing both our messaging as well as our channel delivery to drive the greatest outcomes for our customers and the highest revenue outcomes. Over the last year and a half, we've driven roughly $18 million of incremental revenues through Rosie, and those results get stronger every day based on the machine learning. Rosie's driving better and more timely leads and offers for us. It's increasing our sales and our revenues. By nature of the machine learning, it is a continuous improvement platform, and maybe most importantly, it's prioritizing the best opportunities for our precious banker resources to reach out to our customers and make a difference in their financial outcomes. We've been transforming our retail network strategy actively over the last number of years, and will continue to do so. We're delivering a thin network by using customer and market analytics, and the thin network drives high visibility for us with less sites. It increases the size of our branch trade areas, and it maximizes the reach of bankable population within those branch trade areas. It's allowing us to consolidate very effectively, retaining revenue and relationships, and grow efficiently in the growth markets that I mentioned earlier. Between 2014 and 2021, the end of this strategic planning cycle, we'll have reduced our branch count by 16%, while increasing the bankable households within our branch trade area by 10%. A great trade-off, more growth while doing so more efficiently. This gives you some of the pacing. We front-ended in the thin network strategy a lot of our consolidations. Over the last 5 years, we closed 284 branches. We'll continue to consolidate, and consolidations will outpace the de novos that we put into our growth markets, although the space between those numbers will start to narrow, and we'll also start to benefit from the revenue growth that we're getting from the de novo investments that we're making in these growth markets. The metrics tell the story here. As we've transformed the network, we've increased our revenue per branch, we've decreased our branch staff, and we're greatly increasing the population that we can reach in our branch trade areas. Probably the most important metric on this page is to look at the consumer bank efficiency ratio. This strategy has driven an improvement of 500 basis points over the last 5 years, and we will deliver an additional 400 basis points of improvement over the next 3 years. This strategy plays out a little different depending on the market dynamics. I'll give you some examples. In St. Louis, we had roughly the right number of branches to cover that metro. Unfortunately, they weren't in the right places. Through a series of consolidations and de novos, we repositioned where we were in that market. We actually shrunk by 3 branches, but we improved the growth dynamics of our branch trade area by 190%. In Houston, it's much more of a build-out. We had 25 sites in Houston. We're adding roughly 40 to that. But we're going to increase within our branch trade area by 2.4 million individuals who we can now bank within that trade area. Atlanta's a little bit of both, some realignment as well as some growth. We'll be up net 24 sites by the time we're finished in Atlanta, but we'll have increased almost 1 million individuals in our branch trade area. And in Orlando and Tampa, it's largely an optimization exercise, getting our branches and our sites in the right places. We'll actually be down in total across those 2 markets by 30 branches from start to finish, but we'll have increased the bankable individuals within our branch trade area by roughly 250,000 individuals. In every single one of these cases, we'll have improved the growth dynamics of our branch trade area, we'll have improved the demographic profiles, improved the density, and greatly improved the bankable households within our branch trade areas. And while we've been transforming our retail network, we've also been transforming our retail delivery model to make banking easier for our associates as well as our customers. I mentioned a little bit of how we're doing it for customers. We're introducing them to 24/7 convenience, and they're adopting it in great numbers, allowing us to create efficiencies. But in addition to the migration we're seeing in simple transactions with our customers, we've also invested on digitizing and reducing operational tasks that were taking up the time and energy and resource of many of our associates. This has allowed us not only to get more efficient, but to go to one banker job family, certified bankers in our branches with continuous improvement paths who can deliver more proactive guidance and more value to our customers. Over the last couple of years, we've reduced transaction-focused associates by more than 2,000 FTE, roughly 30%. And while doing so, we've increased our banker interactions by 20%, driving more opportunity while at the same time driving more efficiencies. We've used sophisticated staffing and scheduling models, and this January we actually increased our Saturday hours by 60%. Saturdays are one of the most productive sales and revenue generating days of the week that we operate in. We did this by not adding cost, but by redistributing our scheduling and our plans for our branches during the week, and we've been able to completely self-fund this. We're already seeing great increases in our net checking growth rates based on these Saturday hours and more banker interactions that we're delivering through an enhanced delivery model. We continue to invest in digital in everything that we do. As I've mentioned, it's absolutely critical to our plans to add more value to our customers and focus on high-value interactions with them with certified bankers. Additionally, it allows us to deliver more innovative products and services to our customers. We're now doing instant issue debit and credit cards in our branches. We've introduced digital payments. And from an account opening perspective in the digital environment, we are greatly improving the experience on both the deposit and the credit side, but especially on the credit side. John mentioned a number of the improvements from a standpoint of origination all the way through to booking for our customers and credit. We now have real-time pre-approved credit cards in the digital environment. We continue to make investments there to make it easier for our customers to expand their relationships with us. And last but not least, we're using the digital environment and technology to protect our customers. I mentioned earlier our region's lock-it card controls, allowing our customers to lock and unlock their cards, giving them an advanced level of protection in their payments versus our competitors. And we've also added real-time alerts to make our customers conscious of their payments that are going on. Now I'm going to talk about something that might seem a little contrary based on the way the industry's been going, but we are going to continue to grow our mortgage business. We have a strong operating advantage in the mortgage business that we're going to leverage. The mortgage transaction is still one of the most important transactions that any family in the United States enters into. It's a great relationship product, it's foundational to banking, and it's also a stable and high-performing asset on our balance sheet. But now I want to talk about our operating advantage. We're consistently rated in the top decile on customer service for both origination as well as servicing of mortgages. We have a direct origination model, as I mentioned earlier, not a correspondent model, driving roughly twice the risk-adjusted returns versus correspondent mortgages. And we have an extreme advantage in our cost structure. Our origination and fulfillment costs are 44% less than the industry average to originate those loans, and our servicing costs are 58% less than the industry average. Strong cost advantages in this business that are going to allow us to grab share and continue to be profitable. And it's working. In 2018, through a difficult industry environment, the averages in the retail origination scorecard actually went into negative territory from a standpoint of returns. We stayed in positive territory through that difficult environment. We grew our purchase transactions by 7% in 2018. Our peers shrunk by 5%. And we increased and went up 10 places in mortgage volume during the 2018 year. The strategy is working for us. Some of the tactics that we're using is we are investing in mortgage loan originators in key markets and growth markets, but we're also aggressively investing in both capabilities and originators in our direct-to-consumer unit, which makes it very convenient for customers to get into the pipeline and then execute their mortgage. We pair that with strong digital investments. Over 50% of our mortgage applications are now done digitally by customers who are working with mortgage loan originators in the field as well as those who are coming in directly to us. This allows us to get these mortgages into the pipeline quicker, creates efficiencies in the back office, and allows us to pull those mortgages through very efficiently and effectively. We're also using sophisticated data and analytics to identify customers within our base who may be in the market for a mortgage as well as prospects. We're stimulating that demand and we're driving them into the pipeline and pulling through those mortgages. And we are going to continue to grow our mortgage servicing business. As I mentioned before, it is an extremely efficient business for us. We have roughly $50 billion in balances today, and over the next 3-year horizon, we'll grow our mortgage servicing business another $10 billion in balances. And we actually have capacity to go as high as $70 billion from the $60 billion that we'll grow to without any step function increases in our cost to service those mortgages. A strong competitive advantage. So to close, we're going to continue to focus on leveraging the superior customer service advantage we have with our customers and their brand loyalty as well as their primacy with our bank. We're going to invest in omnichannel to deliver the best experience that our customers can have while at the same time becoming more efficient. We're going to constantly use strong analytics to drive smart touches with our customers, giving them the right information at the right time through the right channels. And we're going to use a strong operating advantage we have in the mortgage business to grow our share in that business and our contribution over time. Maybe the most important indicator to look to from the consumer bank is we're going to build on a 500 basis point improvement in efficiency ratio over the last 5 years to have another 400 basis point improvement in our efficiency ratio as we go forward through this strategic planning time frame to 2021. With that, I'm going to close my remarks, and I'm going to turn the podium over to my good friend and colleague, Bill Redder, of our Wealth Management Group. Thank you.